Good morning. My name is Uday Turaga, and I'm the CEO for ADI Analytics. Welcome to our webinar series. Today we're going to talk about midstream oil and gas and how midstream is faring within the larger context and the perfect storm that the oil and gas industry is currently in. We ran into technical issues with this webinar yesterday and rescheduled it to today. We apologize for the confusion and the inconvenience caused and appreciate your patience and understanding. And thank you for joining us again this morning. We'll quickly introduce ADI and then we'll get into the topic for today, which is where we'll share some insights on oil and gas markets. And then at the end of the webinar, we'll have a Q&A session. Please type your questions in the chat box, and we'll address those questions as they come in. Very quickly, for those of you who don't know us, ADI is a boutique oil and gas consulting firm. We are based here in Houston. We focus on oil and gas, energy and chemical markets in particular. Within oil and gas, we work across the value chain, upstream, midstream, downstream. And we work for a broad range of clients. The way we differentiate ourselves in the market is our team brings a lot deeper industry expertise. We've been around for the past 11 years. We've supported over 150 clients. A lot of work is driven by proprietary data and analytics that we bring to our work. Our work is very analytics intensive. Finally, as a smaller consulting firm, as a boutique player in the market, we are client-centric, have the owner's mindset, and a lot more responsive to clients. We've worked on over 400 projects for a wide range of clients. We do a lot of work for the large oil and gas majors, a number of the refining and E&P independents, as well as increasingly companies overseas as well. We have a pretty strong chemicals coverage as well, and we support a number of companies there. In addition, we've supported a number of companies that supply equipment and services into the oil and gas market. And then finally, a big piece of our project work is for private equity and venture capital clients, especially around transaction advisory. We can help clients in a number of ways. We can help them build strategy and support strategic planning efforts. We can help them with market research and sizing and voice of customer research to support their sales and marketing strategies. In times of uncertainty like this, we can help clients navigate markets by providing original in-depth research that helps them understand how markets might evolve either through scenario planning or forecasts that are all based off of models and analytics. So we can also support clients in a number of other ways that's on this page. If you've been following us on LinkedIn, you'll know that we have been publishing a lot of research. This is a very unique time. It's unprecedented in the sense that we have a supply shock as well, coupled with a significant shock. A lot of the challenges that came from the supply shock early March have rapidly been overshadowed by the demand shock coming from the lockdowns due to COVID-19. If you go to the website that's at the bottom of this page, you'll see all of our COVID-19 focused research and coverage. You'll also find links to our webinars. You'll also find recordings of our webinars there in addition to links to these articles. Later today, we intend to publish a piece on refining, another piece on midstreams coming next week. So keep watching that space if you're trying to look for insightful coverage and research in these on these topics, because we intend to spend quite a bit of time helping our clients understand how they can respond and prepare in these times. We also have a pretty detailed, in-depth report that is available to clients to help them navigate this perfect storm. This is a fairly in-depth study that looks into a lot of issues. We start off with an assessment of oil prices. We look at how much demand has been destroyed because of coronavirus. And then we do deep dives into upstream, midstream, refining, natural gas and NGLs and petrochemical markets. We do forecasts of oil supply, demand balances and inventories. And then we do quite a bit of scenario work in terms of understanding how fuel demand is likely to evolve, how oil prices will likely to evolve in scenarios. For a couple of our, for those clients who are interested, who are supplying services and equipment into the market, we also have forecasts around OPEC and capex, and then also what investor implications and opportunities emerge out of the current situation. This is the second of the 5 webinars that we are hosting at ADI. We had one last week on upstream. The recording for that is available on that website at the bottom of the page. Today is the one focused on midstream. We have 3 more coming up. Next week, it'll be downstream, focused on refining and fuels. The following week, natural gas and LNG markets, and then finally petchem and plastics on May 7th. So please continue to join us for these webinars. We'll try to make them as insightful, helpful as possible. So, in terms of format today, we'll quickly share some thoughts and insights from our research, building on some of the stuff that we have already published on the website. But then we'll have a short Q&A roundtable discussion with a couple of my colleagues who have been working quite hard on a lot of these topics that we are talking about today. I have Swati Singh here with me. Swati is the lead analyst on all our downstream research, but she is working overtime now, focused on also leading all our COVID-19 focused research efforts. And then we have Brandon Johnson, who's a senior colleague of mine. Brandon has worked on a wide range of projects, but midstream is one area where he brings special, deep, differentiated expertise. So with that, let's quickly review some thoughts, and then we'll get into the conversation today. So clearly, right, I mean, we know what has happened to crude oil prices. We continue to see them being battered. The OPEC plus deal, the deal between Saudi and Russia happened somewhere there in the last week or so. And in spite of expectations, the deal hasn't quite performed as well. And the deal hasn't quite delivered the results in terms of crude oil prices. That has not helped address or stabilize crude oil prices. One reason for that is that there's just not enough confidence and certainty in the market that the number that has been floated around OPEC plus cuts, 9.7 million barrels per day is what OPEC plus has promised to cut. Most analysts, including us, don't quite believe that is going to be realized because of the way the deal was structured, because of the way in which OPEC Plus intends to make those cuts. They intend to make those cuts for a couple months and then try to find ways in which they can either increase production or stabilize the baseline that will then allow them to get away with lower cuts. The other reason why there's not a lot of confidence in that number in the market is because today we see oil production is fairly elevated today. Saudi Arabia significantly ramped up production this month following the collapse of the deal in early March. And a lot of these cuts are coming off of fairly elevated levels. So there's just not enough confidence in the market that you're going to see close to 10 million barrels per day of reduction. And therefore, oil prices haven't quite responded the way we'd like them to. So this page shows our oil supply demand balance for 2020 based on our understanding today. So if you take April 2020 as the baseline, the world was producing a little over, almost close to 105 million barrels per day. We expect about 8 million barrels per day in oil cuts. We expect some of the other producers to cut about 1 million barrels per day or so. US shale, if we think based on the current level of capital spending, reductions that have been announced, we think that will lead to about 2 million barrels per day. If you look at some of our research, we have published a running account of how much capex the E&P shale producers have decreased so far. So that will give you some insight into the market. So when we tally all that up, we get to something like 94 million barrels per day. But the problem is, because of COVID-19, the demand for a lot of these, the demand for oil is expected to be just a little over 90 million barrels per day. And that's almost a best-in-class assessment. That's a fairly optimistic assessment. It is possible that the demand might fall even further. So, but even if you assume a conservative demand reduction assumption, you're still looking at an oversupply of a little over 3 million barrels per day. And that's the reason why you haven't seen oil and gas prices necessarily respond to the to the OPEC plus deal that was announced. So coming to midstream, let's start at a high level and go through the value chain. But if you look at the midstream value chain and see, okay, what segments are going to be the most impacted in this environment, we see gas gathering to be fairly insulated in this market. In general, we believe that gas-focused midstream assets are going to be fairly well positioned in this environment. In comparison, crude oil gathering and crude oil-based midstream assets are going to be impacted fairly significantly. Natural gas processing, we think, should be fairly insulated, but in general, going into into this downturn, utilization rates at a number of gas processing plants have declined, and those declines are continuing to intensify, especially in places where there's a lot of associated gas production. So think of Bakken, think of Permian. And we expect those rates to continue to decline, and some of those assets are probably going to be distressed. Fractionation markets, it's really hard at this point of time to get a real good pulse on what is happening in NGL and fractionation markets. We hear conflicting views and conflicting trends in the market. Clearly, some supply is going to be impacted because of oil prices, but at the same time, we are also anticipating some sort of an impact on the demand side, although I think the picture is a little bit more uncertain, primarily because a lot of the NGL that's produced globally ends up in LPG markets. Saudi Arabia has been a big supplier of LPG in the global market. And because of the cuts that they have committed to, it is possible that some of that LPG production might also be impacted. So I think fractionation is a market segment that's worth watching for to get additional clarity going forward. In terms of the transmission pipelines, crude oil pipelines are going to be significantly impacted. We're already seeing project cancellations or project deferrals there. In terms of natural gas, we believe that natural gas is probably better positioned than crude oil at this point of time, primarily because natural gas demand continues to stay up, although if there's a pretty significant recession, we'd expect a pretty big impact on natural gas demand as well. Also, some of the contractual structures help natural gas-based midstream assets a little better, in the sense that most contracts around natural gas infrastructure tend to be longer, have longer terms and periods, while that's not always the case for crude oil infrastructure. Of course, we're also seeing some delays in new assets in transmission pipelines on the gas and the crude oil side coming in. Finally, we have storage terminals. There's a big call on storage capacity at this point of time. We expect that some areas will get constrained from a storage capacity point of view. But in general, we think that there is sufficient storage, at least through the near term, and assuming some of these cuts that have been committed to come through in the market. In terms of whether this is going to be a big opportunity financially for some of the public midstream companies, I think we don't see a lot of impact there, primarily because a lot of the storage capacity that these large midstream players have has already been contracted out for long periods, and it is unlikely that they will have additional storage to contract out at the higher prices that we are seeing in the market. We'll talk a little bit more about this shortly here. So clearly, we talked a little bit about project cancellations and things like that. This is a view of Permian gas production and takeaway capacity that we had shared at our 2020 ADI forum, the annual oil and gas conference that we host every year in February. This year we held it a little earlier in January for some other reasons, and we had shared some of this work there. And in general, there is sufficient takeaway pipeline capacity that was being built for Permian gas. But of course, a couple projects now have been delayed or canceled. And I think this will probably have some impact, but at the same time, we expect the production curve to decline quite substantially in the Permian, primarily because a lot of the Permian gas production is associated gas, and associated gas is where we're going to see big reductions going forward. Oil, on the other hand, was oversubscribed in terms of pipeline capacity going into 2020. This is, again, research that we had shared earlier this year at the ADI forum. And some pipeline capacity deferrals, cancellations are coming in. The Red Oak pipeline, for example, has been deferred at this point or time. Some of the other pipeline capacity, a lot of steel is on the ground. They are well on their way to completion. A couple of projects are expected to be completed shortly, or at least procurement for them is expected to be completed very quickly. And as a result, I think there's a limited opportunity there for operators to walk away from those projects. But in general, we anticipate some more creative ways to address some of the capacity buildup in Permian coming forward. Midstream companies are obviously responding to this crisis pretty aggressively. We have seen big capex cuts from some of the larger midstream players. Plains, which is a large, primarily crude oil focused, liquids focused pipeline company, has made a big reduction in their capex. We have seen similar capex reductions coming in from DCP. So collectively, the industry is looking at reducing capex at pretty significant levels. Now, most of the pipeline company, most of the midstream assets are operated on a utility return model, and therefore the distributions are fairly important to their investor base. And we are seeing similar reductions on the distribution side as well, limiting the opportunity for investors here. And a lot of the companies that have also announced capex cuts are also reducing distributions as part of their forward-looking guidance. Of course, there are a few players who have looked at their capex spending plans and distribution plans, and Magellan Midstream Partners is one good example, where they've decided to maintain their capex guidance and plans, as well as retain their distribution growth guidance. So it's interesting that some midstream players see themselves fairly insulated in this market relative to some of the other players. And this is an example of some of the analysis around companies that we are working on as part of a larger study that's now available to clients. Crude oil exports have been a big driver for growth within the oil and gas industry. They have repositioned the US oil and gas industry into a export-focused economy over the last few years. You can see the trend there around crude oil exports. This will unfortunately be significantly impacted going forward. And we have some analysis on the right side that shows that. So if you assume a $28 break even for Permian crude oil production, and you layer in on top of that transportation cost to the US Gulf Coast from where you'd export crude oil, you're looking at an FOB price of $33.50. In comparison, Brent is about just a few cents over at 33.87. So it's unlikely that WTI will be found attractive as an oil to import, especially given some of the quality differentials that WTI has relative to Brent That's the reason why we think crude oil exports are likely going to be impacted pretty significantly. And of course, if the export outlook gets cloudier, then obviously a lot of the crude oil export projects that have been proposed are likely to be impacted as well going forward. Moving on to some of the storage related issues, which we see as another big theme in midstream markets today. There's been a pretty big uptick in storage volumes. We have crude oil on the first chart on the left. You'll see a pretty big jump relative to the 5-year average. We have fuels, gasoline, diesel, and jet fuel, and you'll see that it has hovered around the 5-year average at similar levels, but not in the recent past, and that has jumped up quite a bit. And then finally, natural gas storage, on the other hand, we see a significant dip relative to the 5-year average, but that number is significantly higher than where we were in 2019. And then, of course, if you look at storage costs, there's been a pretty big ramp up. At a minimum, we have seen 50% increase in storage costs, for example, for jet fuel in European markets. And similarly, the Mediterranean market, we've seen a 25% increase in jet fuel storage costs. We've seen big costs, of course, for crude oil at Cushing, and then for gas oil as well in the European market. Now, of course, the question that's on top of a lot of people's minds is how much storage do we have? In general, if you look at US crude oil and refined product storage, which is the chart on the left, we're currently operating about 70% utilization rate. If you assume that some of the pipelines could be used as storage capacity, push comes to shove, we are looking at about 1.8, close to 1.8 billion barrels of storage capacity. Of course, this at 70% utilization rate, it looks like we have a lot of room, which we think we do. But it is possible that in some markets we might see storage capacity getting constrained. Also, the market, right? Once it's pushed to the wall, it'll come up with creative ways and strategies. We are seeing some interesting strategies around crude storage, and we'll talk about that a little bit here shortly. Globally, there's a lot of uncertainty around how much oil storage capacity is out there. We have seen a couple we have seen a couple of metrics or a couple of estimates for global oil storage capacity ranging anywhere from 4 billion to a little over 6 billion barrels every year. I'm sorry, 4 billion to a little over 6 billion barrels of total available crude oil storage capacity. The general assumption is that this capacity right now is being filled at a very aggressive rate, and in general the view is that probably about 20 to 25% of capacity is still available for storage. Of course, there's a lot of uncertainty around this number, but at least at this point of time, there still seems to be some room available for incremental storage capacity. Now, if you're going in structurally into the market and you think of options that midstream players have, over the last few years, we have seen a significant shift away from MLPs. If in 2017, 50% of market cap was owned by MLPs, only 35% of market capitalization today is owned by MLPs. In contrast, there's been almost a 50% increase in C Corps owning the market cap for midstream companies. And what that does is it allows some of the midstream players greater flexibility, especially when it comes to responding to a big downturn like what we are in today. Another thing that's going to help midstream companies going forward, that's going to bring some stability to the midstream business, is minimum volume commitments. These are often referred to as take or pay commitments. In general, for most of the key plays, we see a lot of the midstream assets having good protection with minimum volume commitments. We think that that's going to bring some stability into the market unless there's a dramatic further decline in oil prices and some of the E&P players start thinking about bankruptcy, which will probably impact Permian and to a certain extent Eagle Ford. But in general, we think that the market has some downside protection coming in from these minimum volume commitments. So with that, let me pause here and let me bring in a couple of my colleagues and help and have them also join and share some of their thoughts and insights. As I mentioned earlier, I have joining with us today Swati Singh, who's an analyst with ADI, and Brandon Johnson, who's a project manager at ADI. Brandon, maybe I'll start with you since you've been doing a lot of work in midstream markets for several years. If you think of, say, the 2014 downturn and you think of this downturn, what's different for midstream this year relative to in the past?
Well, I think from the previous downturn, many of the midstream players were in a different financial position than they are today. So today they're in a better financial position, and this is because after the previous downturn, operators focused on whether it's reducing their leverage, some self-funding, and minimum volume commitment contracts. And as well, many of these midstream players have had recent wins with reaping the benefits of those cash flow today.
Okay. Swati, you've been looking at the storage question quite closely. Are we at a real risk of running out of storage capacity?
Uday, I don't think so, because initially that was the case, but right now, if you look at the crude capacity utilization, it's almost 70 to 75% full. So we still have 25% of the room, and I'm talking about the commercial crude storage capacity. Also on the distillates, gasoline and jet fuel, if you combine them, you see close to 70% utilization there as well. And market is actually coming out with new ways to store. So for instance, we have midstream companies that are actually using NGL wells to store gasoline and distillates. For instance, I think Enterprise Products did that recently. Phillips 66 is another company that is also offering storage options for the crude oil that's coming out of Permian on their Gray Oak pipeline storage system. So it's not full right now, and as the producers start reacting towards the decline in the demand and the production is going to fall in the near term, we should be good with the storage capacity. We shouldn't be out of it.
Okay. One of the questions that has come to us in the recent past has been around play-specific impacts to midstream. Are there some plays where midstream is going to be impacted more over the others? And clearly, this is something that we are researching pretty extensively. And I think there's more to come here from our side. But I think a couple of trends that we see. One is if you look at NGL supply, a lot of it comes from Bakken, and Bakken NGL supply is served to a large extent by one or two players, ONEOK, for example, being the primary player. So I think if there's a significant reduction in oil prices that leads to an impact on NGL supply, we would expect ONEOK's assets to bear the brunt of some of that reduction. So I think there are some interesting play-specific examples like that. Another one is Marcellus. To a large extent, Marcellus is gas-focused midstream assets. A lot of insulation there in the market. A lot of insulation in general in this environment to gas-focused assets, and we expect some of the Marcellus-based midstream infrastructure to be better positioned coming out of this. Brandon, we've done a lot of work looking at private equity in midstream, helping private equity clients who are active in the midstream space, as well as looking at how they are playing in the midstream environment. What happens to the private equity investor in midstream today or going forward from here?
Yeah, so as you said, over the past 2 years or so, we've seen an influx of private capital into midstream markets, most of which came from upstream. And this was due to the low risk commodity price exposure that the midstream had. But I think a lot of investors are realizing that while it's not the same risk as some of the E&P producers, there is some risk associated with investing into midstream markets, and particularly because of the customer side, especially E&Ps, they're at the mercy of commodity prices. So I think going forward, there may not be a significant shift out of the midstream market, but there will be some hesitancy going forward.
Okay, okay. Last thing, Swati, you know, we've been doing a lot of work looking at investor implications for midstream. Are there companies that are well positioned in this environment right now?
Well, yes. So we see that many midstream companies are cutting capex and dividends due to the anticipated cut in their EBITDA. But we do see there are a couple of companies that they just announced that they're going to stick with their 2020 growth capex. For instance, you just mentioned about the Magellan Midstream Partners. They are going to maintain their growth capex for 2020. But they're just going to stick towards the lower end of the capex. But if you talk about one midstream company that is really well positioned in this situation, I would say Enterprise Products. They are really well positioned. That's one because they have a really strong balance sheet, and also they have a very better. So if you compare with the other average counterparties with Chevron, they have a really good tie with Chevron, and they actually have a higher share of oil gathering exit out of Permian. So that will be one of the companies that is really well positioned in this situation.
Okay, excellent. Again, we are not stock pickers, and this device is not steering you towards a particular stock, but something to keep in mind. Brandon, did you have a comment around that?
Well, yeah, somewhat. Just piggybacking on what Swati said. What we do see as well is, if we look in 2014 and 15, a lot of midstream companies, and this kind of touches on the private equity question as well. Mm-hmm. Even though they're better positioned with minimum volume commitment contracts, they're also, it's likely that they will help out their E&P producers by renegotiating essentially against themselves for mutually beneficial contracts with the producers.
Okay, okay. Excellent. Very good. Let's go into the Q&A session. If you'd like to type in a question in the chat box, we are happy to take those questions and address them. There's a question that has come in on the impact on availability of NGLs, particularly ethane, due to reduction in associated gas. So clearly that's a concern, right? I mean, I think as oil production declines and as some of these E&Ps start cutting back on their capex and start reducing some of the oil production, we expect associated gas and NGL production to fall, and as a result, some of the NGL supply is likely going to be impacted. If you look at NGL supply dynamics over the last, say, 3-4 years, the marginal barrel of NGL that was coming into the market was coming not from the Marcellus, but was coming from the Permian, and primarily because of the cost advantage that the NGL supply enjoyed in the Permian. And of course, there's also the cost advantage associated with shipping it to the Gulf Coast, right? So I think some of those dynamics might get impacted. We might see the marginal cost of NGL supply maybe shifting back towards the Marcellus. But there is another factor in this equation, which is the cost of natural gas. Our expectation is that natural gas might get a little bit more expensive. The prices might go up a little bit going forward because of the reduction in associated gas production. Associated gas has relatively low negative break-evens, and therefore that was impacting gas prices quite significantly. If gas prices rise, that might also have some impact on the supply of NGL. We think in general that ethane rejection levels will continue to be high in the market in terms, and that is another factor that's probably going to have an impact as well. But I think net, we expect some sort of a reduction in NGL supply going forward. Well, we are running out of time here. So with that, let me just quickly close the webinar. Thank you again for joining us today. As I said earlier, we have a new report available that's available for purchase or subscription that focuses on helping clients navigate the oil and gas perfect storm. Please reach out to us if this is of interest. We do in-depth deep dives of upstream, and NGLs, refining, natural gas and LNG markets, and petrochemicals. We have forecasts for capex and OPEC, fairly insightful product from our firm. So reach out to us if we can be of help. Join us next week for a webinar on downstream and refining, and watch that space there for additional research. We should be publishing something and potentially something next week as well. So expect new research from our firm coming up on that website. With that, I'd like to thank you for joining us. We'll hope to see you in, next Thursday at 11 a.m. Thank you.